government's plan to save the economy is actually a stealth plan to devalue everything you've ever worked for. What if the biggest financial reset in American history is happening right now in plain sight and most of us don't even see it coming? The United States is caught in a mathematical trap it can't escape. There's really only one politically easy way out: a massive silent bailout of itself. But this won't be a bailout of banks or corporations like we've seen before. This will be a bailout of the US Treasury, paid for by you through the Federal Reserve's printing press. This desperate move threatens to unleash a wave of inflation that could systematically gut the value of your savings, your retirement, and your paycheck. Today, we're going to break down exactly how this is likely to happen, why they may have no other choice, and what it means for every dollar you own. This isn't a wild theory. This is a story about simple, brutal math. And it's a story you need to understand before it's too late. To really get the danger we're in, you have to grasp the sheer scale of the problem. It's a scale so large it's almost hard to wrap your head around. As of late 2025, the US national debt has ballooned to over $37 trillion. To put that in perspective, if you spent $1 million every single day, it would take you over 100,000 years to burn through $37 trillion. It's a stack of $1 bills that could reach the moon and back multiple times. But as shocking as that number is, it's not the scariest part. The truly frightening part is the speed at which it's growing. The US government is running massive deficits, meaning it spends way more than it brings in. For the 2025 fiscal year, the budget deficit is projected to be around $1.8 trillion. And this isn't a one off emergency, it's the new normal. The Congressional Budget Office, or CBO, projects will keep borrowing nearly $2 trillion every year for the next decade. This leads us to the terrifying concept of a debt spiral. It's a financial point of no return. Think of it like a credit card you can't pay off. If you only make the minimum payment, the interest just keeps piling up and your debt grows even if you cut up the card. The US government is in a much, much bigger version of that same trap. The interest payments alone on the national debt have exploded. In 2025, the net interest on the debt is projected to be $952 billion, and it's expected to cross the $1 trillion mark for the first time in 2026. That's more than the entire national defense budget. So every tax dollar you send to Washington goes to pay interest on old debt before a single penny can be spent on roads, our military, or social security. This is the debt spiral in action. The government has to borrow more money just to pay the interest on the money it already borrowed. It's a vicious feedback loop. The projections are sobering. The CBO estimates that under current laws, the debt to GDP ratio, which compares our debt to our economic output, is already over 120% and could hit nearly 118% by 2035, a level not seen since the end of World War II. Some people might ask, can't we just raise taxes or cut spending? Let's be real. The numbers are now so massive that those traditional solutions are barely on the table. There is no tax hike big enough that could realistically fix this, and no politician is willing to make the kind of spending cuts that would even make a dent. The political will just isn't there. This isn't about politics anymore. It's about math. The government has made promises, Social Security, Medicare, and interest payments, that it simply can't keep through taxes alone. Historically, when a government gets into this kind of bind, it has only one politically easy way out. To see where we're going, we first have to see how we got here. Today's crisis didn't just appear out of nowhere. It's the final act of a three-part drama that's been playing out for 30 years. Each act ended in a huge crisis, and each time the risk was just passed along to a bigger group. Act 1, the 1998 LTCM crisis, from hedge funds to banks. It all started back in 1998 with a hedge fund called Long-Term Capital Management, LTCM. This place was run by a dream team of financial geniuses, including Nobel Prize winners. They used complex computer models and massive amounts of borrowed money, leveraged to profit from tiny price differences in the market. It was seen as a money printing machine. But then the unexpected happened. Russia defaulted on its debt, sending a shockwave through the markets. LTCM's risk-free models blew up, and the fund was suddenly facing a collapse so huge it threatened to take down the entire global financial system. So what did the Fed do? They didn't print money or bail LTCM out directly. Instead, the New York Fed gathered all the heads of the big Wall Street banks and essentially forced them to buy out LTCM's bad bets for $3.6 billion. The crisis was stopped, but a dangerous precedent was set. The risk didn't vanish. It was just moved. The hot potato of financial risk was passed from a few speculative hedge funds to the balance sheets of the major banks. The public didn't really notice, but Wall Street learned a lesson. If you get big enough, you'll get saved. Act 2, the 2008 financial crisis, from banks to taxpayers. 10 years later, in 2008, where did the next crisis hit? Exactly where the risk had been moved: the big banks. After years of low interest rates, a gigantic housing bubble had formed. Banks were giving out subprime mortgages to just about anyone. Then they bundled these risky mortgages into complex products and sold them to investors worldwide as safe investments. When the bubble popped and people started defaulting, these products became worthless. The whole financial system froze. Banks stopped trusting each other, and one by one, giants like Lehman Brothers started to fail. This time, the problem was too big for the banks to save themselves. So, the risk was passed again. The government stepped in with the TARP program, a $700 billion bailout. And where did that money come from? It came from you, the American taxpayer. The hot potato was passed from the bank's balance sheets to the public's. Through government debt, every citizen was now on the hook for Wall Street's bad bets. This time, the bailout was front page news, and it made people furious. But the lesson was learned. Too big to fail was now official government policy. Act 3, the 2020 crisis, from taxpayers to the government itself. That brings us to the final act. It actually started in September 2019 before the pandemic, when the financial system's plumbing, the repo market started to break again. This time, the system was choking on the sheer amount of debt the US Treasury was issuing. The Fed had to step in with emergency loans. Then, when the pandemic hit, the crisis exploded. The government had a choice: let the economy collapse or unleash an unprecedented wave of stimulus. They chose stimulus. But this time it wasn't a bailout funded by taxes. It was funded by creating money out of thin air. The Fed's balance sheet, which was under $1 trillion before 2008, had already grown to $4 trillion. In response to 2020, it more than doubled again, peaking near $9 trillion. The Fed printed trillions, handed it to the government, and out went stimulus checks and PPP loans. In this final act, the risk was passed one last time. It moved from the taxpayer directly onto the balance sheet of the government itself, with the Federal Reserve as its enabler. The hot potato has now arrived at its final destination. It can't be passed to the banks. They're not big enough. It can't be passed to the taxpayers. They're tapped out and angry. The risk now sits with the US government itself. And that sets the stage for the next crisis, a crisis where the government is the one that needs the bailout. So, what happens when the one doing all the bailouts is the one that needs bailing out? That's the corner the US government has backed itself into. It's caught in a debt spiral with no easy way out. This is a classic sovereign debt problem. And when a country hits this point, it has three basic options. Default: just admit you can't pay your debts. This is unthinkable for the US because the entire global financial system is built on the idea that US bonds are risk free. Austerity: dramatically cut spending and hike taxes. Like we said, this is politically impossible. No politician who wants to get reelected will vote to gut Social Security while also doubling everyone's taxes. Devaluation: quietly print the money to pay the debts. Guess which one they're most likely to choose? Option 3 is the path of least resistance. It's subtle, it's confusing for most people, and it lets politicians avoid making any hard choices. This is the final bailout. Here's how it would work. The Treasury needs to sell trillions in new bonds every year to cover the deficit and pay back old debt. But eventually, the usual buyers, investors, foreign countries, pension funds are going to get nervous. They'll either demand much higher interest rates or just stop buying. When interest rates spike, it kills the economy and makes the government's debt spiral even worse. They can't let that happen. So, the Federal Reserve will likely step in as the buyer of last resort. They have fancy names for this, like yield curve control or quantitative easing, but let's call it what it is: debt monetization. The Fed just creates new money out of thin air and uses it to buy the Treasury's bonds. This does two things: it gives the government the cash it needs to pay its bills, and it keeps interest rates artificially low. To the government, it seems like a magic trick. They can keep spending without raising taxes, and they can manage their borrowing costs. They are, in effect, bailing themselves out. But there's no such thing as a free lunch. This solution comes with a devastating price, a price that won't be paid by the government, but by you. This act of creating trillions of new dollars to pay for old debts is a direct assault on the value of every dollar you have. This final bailout, this mass monetization of government debt, isn't a bailout of the people. It's the potential destruction of your savings to solve the government's debt problem. The weapon of choice is inflation. We've all felt the sting of inflation recently, but what could be coming might be a different animal. The inflation we saw in 2021 and 2022 was mostly driven by supply shocks and a burst of stimulus cash. The kind of inflation created by monetizing the debt is often far more persistent and corrosive. Think of it this way: the economy has a certain amount of stuff, goods and services. Money is just a claim on that stuff. When the Fed prints trillions of new dollars to fund the government, the amount of stuff in the economy doesn't change, but the number of dollars trying to buy that stuff explodes. More money chasing the same amount of goods means prices go up. It's simple supply and demand. The value of each dollar you hold goes down. This isn't just a temporary spike, it's a potential debasement of the currency. Every dollar in your bank account, your 401k, and your wallet will buy you less and less. If you have $100,000 saved and the government engineers a period of high inflation, that $100,000 might only have the buying power of $50,000 in a few years. The number in your account looks the same, but its value has been stolen silently through inflation. This is what economists call financial repression. The government holds down the value of your savings to slowly and quietly pay off its own enormous debts. It's a hidden tax, a tax on anyone who was responsible enough to save for the future. Your wages could struggle to keep up. Your cost of living, from groceries to gas, could rise relentlessly. Retirees on fixed incomes could see their purchasing power decimated. This process transfers wealth from savers to debtors, and the government is the biggest debtor of all. They'll tell you it's to stabilize markets or ensure the full faith and credit of the United States. But the reality is they may be choosing to sacrifice your financial future to save their own unsustainable spending habits. They're devaluing the currency because they are mathematically and politically trapped. The final bailout is the end game, and the erosion of your wealth is the cost. The financial world is changing faster than ever. The old rules don't apply anymore. Understanding these powerful forces is the absolute first step to protecting yourself. If you've learned something and want to stay ahead of these shifts, do me a favor and hit the like button and subscribe to the channel. Don't get left behind. So, if a likely government solution is to devalue the currency, how do you protect yourself? This isn't financial advice, it's about understanding the basic principles of wealth preservation when money itself is being debased. The key is to start thinking about moving your capital out of things that can be printed and into things that cannot. When the currency is being devalued, holding large amounts of cash is like holding a melting ice cube. It's guaranteed to lose purchasing power over time. The same risk applies to government bonds. For decades, they were seen as the safest asset on earth. But in an era of financial repression, you are lending money to an entity whose unofficial policy may be to pay you back with cheaper dollars. One potential solution is owning real assets, assets whose value doesn't depend on a government promise, but on their real-world use, scarcity, and demand. Think about productive businesses. Owning stock in well-run companies that make things people actually need is a classic inflation hedge. These companies can often raise their prices and their revenues can grow in dollar terms, helping to protect your purchasing power. Think about scarce assets like gold. For thousands of years, gold has held its value because governments can't just print more of it. It has no counterparty risk. When people lose faith in paper money, they often turn to gold. And in our modern age, a new asset has appeared with similar properties. Bitcoin. It's a decentralized digital asset with a fixed supply of 21 million coins set in code. No government can create more. This verifiable scarcity makes it, for many, an interesting hedge against currency devaluation. Even real estate can be a powerful tool, especially if you have a long-term fixed-rate mortgage. The property itself is a real asset that tends to rise in value with inflation, but the loan you use to buy it is a fixed dollar debt. As the government creates inflation, you're paying back that loan with ever cheaper dollars. The common thread here is moving your wealth from financial instruments that are just claims on currency to real assets that have their own value. The old playbook of just working hard and saving dollars is no longer enough. In this new era, you have to become an investor, one who understands that the biggest risk might not be market crashes, but the slow, silent decay of the currency itself. Financial literacy is no longer a luxury, it's a survival skill. We are standing at a major turning point in financial history. The story of the last 30 years is a clear progression. Risk was passed from hedge funds to banks in '98, from banks to taxpayers in '08, and finally from taxpayers to the government itself in 2020. Now, there's nowhere else for the hot potato to go. The US government is caught in a debt spiral of its own making. The numbers are staggering, and the political will to fix it the hard way is gone. All that's left is the politically easy path, the printing press. The final bailout won't be a single event. It's more likely to be a slow, steady process of debt monetization and currency devaluation. It is the government's quietest solution to its debt problem, and it is a direct threat to your financial future. They won't announce it. They'll use confusing jargon to obscure what's happening, but the end result is the same. The value of your money could be sacrificed to keep the government afloat. But you don't have to be a victim in this story. Just by understanding this process, you are already way ahead of most people. You can see the writing on the wall. You can recognize that in a world of unlimited money printing, real wealth is found in things that are scarce, productive, and real. By the time the final desperate moves are made, it will be too late for most people to adjust. The winners in the coming years will be those who understood the game, saw the risk, and prepared for it early. The time to open your eyes is now. A great wealth transfer is likely already underway. The only question is, on which side will you be?